Alrighty. Sounds good. Well, thank you very much for having me today. I really appreciate it. Hello. I'm going to let these disclosures roll through. My name is Keali Jo. I'm excited to be hanging out with you today. A little bit about myself. I am a three-time graduate from the University of Nebraska. I have my undergraduate in accounting and finance, my master's in accounting, and my Juris Doctor from the University of Nebraska College of Law with an emphasis on estate planning and business transactions. So it's safe to say I never want to stop learning. I really love what I do and I enjoy kind of just doing the research and just being involved in all these business plans. And hopefully I'm able to help you and your clients kind of achieve the goals that they're setting for themselves. So today we're going to be talking about executive compensation, and this is actually going to be a little bit kind of like a condensed version of our Boom series. Now, our Boom series, for those of you who are not familiar with it, Boom stands for Business Owner Opportunity Masterclass, and what this is, it's an eight series schedule, or it's an eight module series, excuse me. And that series, we're on module about six right now. That one's coming up here in August. But it's a series designed to help business owners kind of identify planning opportunities or help agents identify planning opportunities for business owners when it comes to things like executive compensation, charitable giving, disability, buy-sell agreements, succession planning, etc. So if you're interested in checking out any of the previous modules, we did this one, executive compensation. This is module one. We also did disability, buy-sell, estate planning, and wealth management so far. Those are available for you on Ameritas EDU in case you are interested. And I'm always happy to send out links to anybody who needs them. But today we're going to be going over executive compensation. We're going to cover what's the cost? Why are we here? Why do we care about executive compensation? What you can do about that cost. We're going to specifically talk about Section 162 bonus plans. Now, I was asked here today to talk mainly about Section 162 bonus plans. You'll see when we get to this topic that it's really simple and it's not a very long conversation. So we're actually going to kind of give you a little bit of a bundle bonus where we're going to talk about non-qualified deferred comp and then split dollar plans like DER and sport. These are just other executive compensation methodologies that you can use to help your client. These are just fun ones. And again, if you have any questions, don't ever hesitate to stop me and ask. I will have the chat up and I really encourage it because this will not take the full hour. So diving right in, what is the cost? So executive compensation planning, what is the cost? So what if you don't really care about what you're dealing with your executives? Let's say we just pay them a flat salary. What is the potential risk here? Well, when it comes to paying an employee a flat salary, essentially what you're doing is you're saying, I value you for X amount of dollars, but outside of that, we don't want you to go the extra mile. We don't really care if you stay or go. Because what's it going to cost if that employee leaves? It's going to cost you, we're going to have to find somebody else. That's going to cost you HR hours to put out the ads, to actually interview people, to bring them in. Let's say you interview a bunch of people, that takes days, weeks, months, could take years. Interviewing people, you have to onboard them and train them. Once they're in, you have to continuously learn and develop. So they have to pay for um, continuing education expenses, etc. So the apparent costs when it comes to losing an employee are, you have to replace them and all the costs that come with replacing that employee. But there are some non-apparent costs. There are some hidden costs. So what are those hidden costs when it comes to losing an employee? Well, the first one is it can take a hit on the company morale. So essentially, the company itself, well, the company morale. When you have your best friend at work, you love going to work every day to see them. You enjoy them, you talk to them, they make doing your job so much better. What if your best friend leaves? Well, then you're not as happy to be at work. The morale goes down. So you don't really think about that when you have a key employee that leaves, that maybe kind of drives everyone else, that really influences everyone else. When they leave, it might want to trigger other people to leave as well because they're not enjoying their time as much. It also costs the reputation of our company. Why are people leaving? The more people that leave, there may be an issue with management. What is the cost here when we look at people who are leaving? Recruitment by other competitors. If you don't make it too expensive for other competitors to come in and take your people, they can come take your people. If I'm just paying you a flat wage, well, all it's going to cost me to scalp your person is to pay that flat wage plus a little bit extra. So we want to make it more expensive for the competitors to actually come and take people away from us. We already covered cascading turnover. If the person that really kind of holds the team together leaves, the team is likely to leave as well. And lower productivity. Maybe this person encouraged you to work harder. Maybe they made the teams more efficient. These are all hidden costs that you don't really think about when it comes to losing an employee. So what can you do about losing an employee? Well, you've probably heard this saying, the golden handcuff. What is a golden handcuff? Well, a golden handcuff refers to the financial incentives or contractual agreements designed to retain executives within a company by making it harder for them to leave. So essentially, you're saying we want to put in place some kind of compensation structure that makes it harder for them to walk away. If it's just a wage and I quit tomorrow, I know what I'm losing. I'm losing the wage that I lost today. But what if I have, let's say, stock options in the future that haven't vested yet? Well, yeah, I'm losing that wage now, but now I'm also losing that thing that I don't have yet that's I'm supposed to have at some point in the future. It'll make me want to stay. Not only can golden handcuffs kind of incentivize you with just financial incentives to get you to stay, it can also incentivize your employees to kind of restructure their behavior to meet company goals. So let's say I do stock options, for example. Again, stock options. Stock options, you want to incentivize long-term behavior because you want your employees to work hard and increase the stock price. And increasing the stock price temporarily isn't going to help them if they don't get their stocks until 10 years in the future. We want sustainable long-term growth. So by granting a stock option, we're going, okay, we want you to have sustainable long-term growth. We want you to work towards that, in addition to saying, if you leave us within those 10 years, you get nothing. So don't leave us and make sure you're working towards the right goals. There's many ways that you can structure compensation to kind of incentivize your employees to do whatever the goals are that you have. So, what are the benefits of golden handcuffs? It reduces executive turnover. It's an expression of goodwill. You value your employees. Your employees are generally the biggest value driver in your business, and that's any business. I don't care what you do. The employees are the ones that generally drive the value of the business. So, it is super important not only to retain them, but to attract and recruit good talent and reward them. So we need to recruit, retain, reward. Those are our 3 R's at Ameritas: recruit, retain, reward. When it comes to executive compensation, we want to make sure that we're doing all three of those. It's an expression of goodwill, like we said, loss aversion. It increases the expense for poaching competitors. This is something we brought up earlier when it comes to if I have company A and company B, I'm paying my employee 100K, but I'm giving them an extra 50K in stock bonuses. Well, this competitor now to poach my employee has to pay $150,000 instead of $100,000. We're making it harder for them to come in and take our employees, as well as making it harder for the employees to want to leave. So what about the executive? Like, this is great for the employer, but what about them? Well, they get retirement savings in excess of qualified plan limits. So with like IRAs and 401ks, there are contribution limitations. Well, for your higher income employees, they may already be hitting those contribution limits. And there's kind of a reverse prejudice here. When you have a high income employee that's actually getting a lot in wages, they are limited in how much they can save for retirement. While a lower income employee, they can save the same amount, but it's actually replacing a higher percentage of their salary. So let's say if I make 50K a year and I'm only allowed to put away 7,000 every year, I can replace that 50K much faster than if I made $1 million a year and I can only put away 7,000 every year. So we're kind of supplementing that ability to save for retirement with our higher income individuals by putting in executive compensation plans outside of your traditional IRA 401K. It provides greater retirement security because we're saving more for them. You can use life insurance to fund the executive compensation. In fact, all four that we're talking about today are funded by life insurance, and it's a really great opportunity. It's a way to provide alternative compensation structures that can achieve a variety of different goals. And you're recognizing your employees. That is so important to provide recognition to your employees. I know talk is cheap, but it does have value. It's cheap, but it does have value. So we want to put our money where our mouth is. We're going to actually compensate our people more and recognize them by the company and say, you're doing a great job. I want to compensate you for doing a good job, putting our money where our mouth is. So we have something called our Source in Six. And our Source in Six is geared at business owners. It is a little flyer that we have that we call our Source in Six questions, which was designed to help you facilitate a conversation with business owners depending on the topic that you were dealing with. We kind of separated business owners into 6 different topics, one of which is executive compensation. And this was just a single sentence, and it's designed to kind of start the conversation. It's designed to be open-ended. We don't want a yes, no answer. It is purely just to get your client to think. And the question is, what would you do if one of your key employees didn't show up for tomorrow? And this gets them thinking of a couple things. First of all, it makes me think, well, who is my key employee? Who are those people? And spoiler alert, if they can't think of who the key employee is, you're looking at them. They are the key employee. There's always a key employee. If they can't think of who that is, it is them, the owner, and they are just as important. We need to recruit, retain, and reward them as well. So this is another thing that you can use with business owners, depending on if we're talking about a business owner or an employee. So one, it makes them ask, who are our key employees? The second thing it makes them ask is, what would happen if they didn't show up tomorrow? What's that going to cost me? Is it just going to be like, can I have Billy Bob here down the row fill in for him? Is that going to be easy, or is he irreplaceable? How much is that going to cost me? And then finally, it gets them thinking about solutions. Okay, if this is going to cost me X dollars, how am I going to mitigate that damage? What can I do? So this is when your client comes to you and they're like, okay, well, where do I start? Well, there's a couple questions that we want to keep an eye out for. Generally, it's good to just listen to your client and hear kind of what they're talking about, like hear what their goals are and what they're trying to achieve. But these are some key things that I would just recommend kind of keeping an eye out for when having this discussion. Number one, who's the plan going to benefit? Remember, we talked about business owners versus a non-owner employee. A business owner can be an employee as well, and they can be a key employee, which means they can be entitled to certain executive compensation benefits, depending on what it is and what type of entity they are. So we need to know, are they a business owner or are they not a business owner? You don't have to worry about the specifics. Just when you have a case like this, if they're a business owner or a non-business owner, tell us and we'll help you navigate that process. The next thing you need to know is if it's for a key employee, if it's not for a business owner, if it's for a key employee, we need to start asking some follow-up questions. For example, who controls the policy or the benefit? Do we want the company to hold on to the policy? Do we want the employee to hold on to the policy? Who gets the death benefit? Are we splitting it between anybody, etc.? Is there any tax deductibility for the employer? Is that important for them? So like when it comes to executive compensation, we have something called a matching principle in taxation. And what is that matching principle? Well, the principle says when the employee includes the compensation in their income, the employer gets to take a deduction. We're matching it up. The employer can't take a deduction until the employee includes it in their income. So depending on the compensation we have, we may be paying them today. So they're going to include it in their income today and we get a deduction today. Or we may have a compensation structure that says work for me for X amount of years and I'll pay you at that point in time. Then our deduction would be at that point in time. Let's say it's 10 years, it'd be at 10 years in the future. So is it important for the employer to get a deduction today or a deduction in the future? Another one is cost recovery, important to the employer. For some of the structures that we're about to talk about here, cost recovery is going to be a possibility for some of your employers. You may not think, okay, compensation, cost recovery, how am I going to get my money back? But there are some cool ways that we can structure that to make that happen. And finally, plan simplicity. In fact, I would argue plan simplicity and control are really what these kind of boil down to. In fact, we even made a chart, complexity versus control. How much control can the company have over the policy and over the asset, which would be the life insurance in this case, versus how complex we want the plan to be? Do we really want to bring in a third-party administrator to have to figure this out? Do we have to bring in additional help and hire an attorney to draft a document? How much complexity is this going to introduce, or is this just something I can maintain on my own? So this is our complexity versus control graph, and it's talking over the 4 different types of compensation that we're going to be covering today. So the first one is executive bonus, and that is our Section 162 bonus. It's low on the complexity and it's low on the control. 9 times out of 10, you're likely going to actually end up over here just because it tends to be a little bit easier for your client to digest. Now, going up the complexity and the control, we're going to have DER, which stands for Dual Executive Reward. Now, this is the marketing name for us. In the wild, it would be referred to as endorsement split dollar. But this increases our complexity, but it also increases our control. This one is a great option for many people as well. Up the ladder, we have SPORT, which stands for Supplemental Platinum Recovery Tactic. And this is a marketing name. In the wild, it is known as Loan-Based Split Dollar. And finally, non-qualified deferred compensation. This is the most complex and has the most control. These plans can range from large, like very far and wide, depending on what they are, but they introduce a lot of complexity. So what are we going to start off talking about? Well, we're going to start off talking about executive bonuses. So what is a Section 162 bonus? A Section 162 bonus, in its most simplest form, is when you have a cash bonus that you're giving to the employee. So we have our employer over here giving a cash bonus to the employee. The employee takes that bonus and they use it to purchase an insurance policy, and they're going to pay the premiums with the bonus. So they take the premiums, put it in the insurance policy. Well, because they got paid, it's included in their income taxes. The employer gets an immediate deduction today. So the employer pays, they get a deduction because it's included in the employee's income. The employee got cash, we're including it in their income. But what happens to the death benefit, the cash value, etc.? Well, because the policy is owned by the executive has full control over the cash value and the death benefit. They get to pick who that goes to, and they get to use it during their life or after their death. However they pick, they get to choose. They have full control over the policy. The employer does not have control over the policy. So that's how it works. But what are the benefits? Well, the employer gets immediate tax deduction. Now, we can introduce a limited control in here called a REBA, which stands for a Restricted Executive Bonus Agreement. And essentially all this is just a little contract on the side that says you promise to only use these cash funds for these things. So we would say you promise employee to only use X amount of cash that I'm about to give you to buy this insurance policy. That way they're not actually spending that money on something else. They're actually spending it on what we want them to spend it on. Now, these restricted bonus agreements, these REBAs, they don't really add too much to this arrangement because keep in mind, the employee has no golden handcuff on. There is no incentive to stay here. We're just paying them. We're giving them cash. They can take and run with it. Same, even if you put that contract in place that says they have to spend it on insurance, cool. They take the cash, they spend it on the insurance, they take the insurance, and they can run with it. There's no golden handcuff here that's going to incentivize them to stay or to incentivize any change in behavior. So let that just be a kind of a drawback here. There's no control. We're low on the complexity, low on the control. You can double bonus the executive, so the employer can choose to double bonus. So what is a double bonus? A double bonus is when you pay cash, so we're giving that cash bonus. But notice when we pay a cash bonus, the employee has to include the cash bonus in their taxable income. They have to pay taxes on it. And the employee probably doesn't want to pay taxes on it. They just want that bonus. And maybe the employer wants them to have the whole bonus. So the employer is going to double bonus. They're going to pay you your bonus, and then they're going to bonus an additional amount that's going to be sufficient to cover the tax. So we're double bonusing. We're bonusing the full amount and the amount to cover the tax. This can provide provincial tax leverage for owners from the employer side, which essentially just means that they can control the deduction. If they need a deduction today, they can go ahead and bonus out to their employee and get that deduction. On the executive side, the benefits is immediate income. Well, that's not a benefit. This is just kind of everything. There's immediate income taxation. The employee has to include the bonus in their income today. Why? They got cash today, they have to put it in there. As soon as they have cash, as soon as they have the right to the cash, it must be included in their income. The executive can benefit from the double bonus structure that we just talked about. The executive gets control over the policy, so the employer does not have control. That's a downfall for the employer, but it's a benefit to the employee because they get full control over the cash value. If they need funds, they're welcome to withdraw or take loans against the balance, etc. They have full control. However, they will be limited in their control if there's a REBA in place. So, like I said, Section 162 bonus, it's low on the complexity, low on the control scale. It's very simple. I'll show you this graph one more time. We're taking that bonus, we're putting it into a life insurance policy, and the employee is paying the tax, and the employer gets a tax deduction. All it is a cash bonus. So that's a Section 162. Let's go ahead and go to the opposite end of our scale. So before we were on this end, executive bonus, low complexity, low control. Well, let's go to the opposite end of the scale, non-qualified deferred compensation. So this is high complexity, high control. So what is non-qualified deferred compensation? So you may have heard of the terms thrown around as this is a qualified plan or this is a non-qualified plan. Well, what does qualified mean? Well, qualified generally means that it is subject to ERISA requirements, which is like an Employee Retirement Act. ERISA requirements. And they generally require under ERISA that you, if you're going to provide compensation to one of your employees, you have to provide compensation benefits to all of your employees. So, for example, if I provide health insurance to X employee, I have to provide health insurance to Y employee. If I provide a retirement plan of retirement matching, that's a qualified plan to one employee, I have to provide it to every employee. There cannot be discrimination. Now, non-qualified, however, allows for discrimination. It's still subject to certain requirements, but it means that you can discriminate against your employees based on what their job is and how much they make. So if you have a key employee like an executive or somebody who, like an executive or somebody who just has a really high income that's really valuable to your operation, you can justify giving them a bonus and not giving that same bonus to everyone else in your business. So non-qualified deferred comp is essentially a bonus that you can give to the employee that does not fall under the requirements of ERISA. Now, this bonus can take any shape or this bonus can take any kind of shape or size or form, however you want it. I can say, you employee, you promised to work for me for 15 years. And then if you work for me for 15 years, you're going to be vested with X amount of dollars and I'll pay you that. That can be at some point way in the future. It doesn't have to be short term. It can be very long term. It can be pretty much anything. So as long as the employee satisfies the conditions to receive the benefits, the employer can begin to pay those benefits once they vest. Now, one of the main conditions of non-qualified deferred compensation in order for it to defer, because this is deferring your compensation, the employee isn't getting any money today. They're getting money at some point in the future. So they're not including anything in their compensation today, but deferring their income out into the future. So the employer doesn't get a deduction for anything until the employee gets it in their income at some point in the future. But one of the requirements for non-qualified deferred compensation is that it must have a substantial risk of forfeiture. Now, a substantial risk of forfeiture just means that if the company's creditors were to come knocking, so if the company were to default on their debt and the creditors were to come knocking, that the life insurance policy or any funding that was set aside or not set aside for this non-qualified deferred compensation, any money that's designated for this must be subject to the claims of the creditors. So we can't formally set aside a pile of money and say, no creditors, this belongs to my employees because I have to pay them at some point in the future. That won't work. You'll lose your deferral status. There'll be a ton of consequences. But instead, we have to say, okay, creditors, in the event that I default on my stuff, you can take this asset, even though I wanted to use it to spend it on something else. So we can't formally set aside funds in order to pay this obligation. And that's what it means to be non-qualified, or not non-qualified, a substantial risk of forfeiture. So what are the benefits of this non-qualified structure? Well, there's massive control here. The employer can control everything about this transaction. They can write out, you have to do this, you have to work for me for X amount of years, you have to have this performance metric, etc. The employer also has a deferred tax deduction. So like I said, they can't include any of the deduction until the employee includes that amount in their income, and the employee won't include any amount in their income until they have a right to it at the future. So if you say you work for me for 10 years and then I'll pay you, they don't have a right to that income till the 10-year mark, and then we include it and then we get the deduction. For the employer, informal funding with life insurance. So because you cannot set aside funds, because we have to have that substantial risk of forfeiture, a great way to informally fund one of these arrangements is to use life insurance. So we're setting aside premiums. We get a life insurance policy on our employee. It's like a key person policy. If we don't end up using it, we can use it for replacing them. Like, let's say they leave the company and they forfeit their options. Well, we can use the funds in the life insurance policy to actually hire someone else and replace them, those replacement costs we talked about. But let's say they stay with the company for a long time. Well, what we could do is we can say, okay, in lieu of me paying you X amount of dollars, I'm going to distribute out to you this life insurance policy that you are the insured on, that I've been paying, that has X amount of cash value built up into it. And that's going to be an equal value. So that's what I'm going to pay you. So instead of paying you cash, I'm going to pay you the life insurance policy. Or the employer can kind of make it however they want to. Let's say they want to keep the life insurance policy and they'd rather just pay the employee cash. They can do that. All that's required under the agreement is that they pay X dollar amount. That dollar amount can come in any shape or form, including life insurance. Now, one part of the downside of these non-qualified deferred compensation arrangements is they require a ton of third-party administration. This is that complexity. You're going to have to bring in a TPA to come administer it. You're going to have to bring in attorneys to draft it and make sure that it's in compliance. You're going to have to bring in accountants to calculate the tax value. It's a lot of upfront cost and a lot of maintenance cost. So that is a detractor from here, but it is a consideration for the employer. As for the executive, as long as he meets the service requirement, they are going to get what they are owed, which is wonderful, except for that substantial risk of forfeiture. That substantial risk of forfeiture is going to, it could be a problem in the future, and I'll show you an example of that here on the next slide, but substantial risk of forfeiture is a massive drawback for the employee. Now, benefit for the employees, they receive that additional retirement income, like we talked about earlier, if they're that high income client, or if they're that high income employee that may not be able to save as much of a percentage of their income through traditional means, this would be a great way to do that. And then life insurance benefits, they get a life insurance policy out of the deal. They get more than just a cash salary. They'll get a life insurance policy. Now, for an example of that substantial risk of forfeiture. So this is a little snippet from a news company. This is Reuters, I believe. And it says, bankrupt Westinghouse ends pensions for ex-CEOs executives. So they essentially they filed for bankruptcy and they were unable to continue to make pension payments to their employees. And because they were using some non-qualified deferred compensation arrangement and it was subject to a substantial risk of forfeiture, well, they couldn't continue paying the employees because it had to be eligible to the claim to the creditors. So they're not permitted to make any more pension payments to the retired executives because it is a non-qualified plan. So that is the danger of it being subjected to a substantial risk of forfeiture, is if before it vests, before it's owed to the employee, if something happens to the company and they were to go under, they would take the entire bonus with them. That's what it means to be substantially subject to a risk of forfeiture. So be very aware of that. Now let's backtrack down here a little bit. Let's move on to split dollar plans. So we're going to talk about split dollar plans, DER and sport. These are two different versions of a split dollar plan. It's an endorsement and a loan-based version. They are alterations of the same methodology, but before we go into the specifics of them, I think it's best to just kind of define what a split dollar plan is, because it's way simpler than you think it is. A split dollar plan just means we're splitting some of the benefit of the life insurance policy between more than one person. So we're splitting the benefit. That's a split dollar plan. See, attorneys and accountants are not very clever. They tend to name things as they are. So a split dollar plan is when we're splitting that benefit. So how we split that benefit, whether we're splitting the cash value or the death benefit or both, and who we split it between, how we split it, how we structure it is really going to change whether it's going to be loan-based or endorsement split dollar. So starting with DER, dual executive reward, this is that endorsement split dollar. How does it work? Well, what happens is and actually, I'm going to come back to this graph because I have a step-by-step guide of how it works here coming next. So let's go through the step-by-step guide and then we'll come back to this main graph. So dual executive reward, first things first, the employer and the executive enter into a bonus agreement and a split dollar agreement. The bonus agreement says we agree that you work for me for X amount of time or you fulfill X amount of obligations and I will pay you Y amount of dollars. Whereas the split dollar agreement says, okay, you employer have the right to take out an insurance policy on the executive and own it. And then we are going to split the death benefit this way, and we're going to split the cash value this way. So how are we going to split it up? Well, with DER, generally what ends up happening is the life insurance death benefit is split between both the employer and the executive. So that way, if the executive were to pass away before it were to vest, then the employer would get a portion of the funds, a portion of the death benefit to reimburse what they paid for it, the premium that they've already paid to maintain the policy. They'll get a reimbursement for that. And the remaining death benefit, if any, will go to whoever the executive identifies as their beneficiary. So as long as the executive goes ahead and works that entire service period, if they work the entire service period, they're going to go ahead and get their entire bonus. So let's back it up to that original graph here. So what do? We enter into an agreement. The employer is going to pay the premium. into the life insurance policy. And as they pay that premium, we're going to split the death benefit. So prior to transferring it, prior to it vesting and the employee fulfilling their obligation, the employer gets to hold on to the entire surrender value, the entire cash value of the policy because it's an asset on their books, but they split the death benefit. They say, you employee, if you pass away, you're going to reimburse us first, and then whatever's left over is going to go to whoever you want, whoever you identify. But then let's say the employee continues and they fulfill their service requirement. Well, once they fulfill their service requirement, the employer is going to transfer the policy. This is that post-transfer down here. That way, the employee will be able to take out policy loans, have access to the surrender value, and have access to the full death benefit. No amount would go back to the employer. And it's at this point in time when we transfer it over that we're going to include it as our income tax to the employee and get a deduction to the employer. I see we have a question here. How long until the employee is vested, or is it decided by the employer? For all of these, it is decided by the employer. Okay, going back to DER. So that's all it is. So you enter into an agreement. The employer says, hey, I'm going to own this policy. It's going to be on my books. I'm going to have access to the cash value. That way, if anything were to happen and I needed access to this, I can access the policy and take out some cash. But as long as I'm able to pay you at the end of the service period. So by the time that the service period is over, I have to have those funds set aside. Those funds could be cash or any other asset, but we're funding it with a life insurance policy. So we're taking that life insurance policy and we're distributing that out instead of cash, but it could be either. It really depends on the employer. So we're introducing more control here, but we're also introducing a little bit more complexity. Let me skip over these. So what are the benefits of DER? The employer gets to control the benefit completely. The employer owns the asset is on their books. They're the ones who are able to take out loans or withdrawals or however you want to do it with the cash value of the policy. And that's only before the employee is vested. Once it's vested, they're going to have to pay it out, whether that's paying out the policy or cash. There's lower administration costs than the traditional deferred compensation plan. Really, the only administration cost you have here is the cost to calculate what we call the economic death benefit. And really what that is because we're splitting that death benefit between the employer and the employee, there is some kind of value that's being transferred here. And under the tax law, whenever there is a transfer of value, there must be a tax. So what's the transfer of value here? Well, the employee doesn't get anything right now, but when they pass away, their beneficiaries get something. So that's a value. They get the death benefit. They get to pick the beneficiary of their portion of the death benefit, even though they're not entitled to any compensation right now. So that is a taxable event. But how do we tax that? It doesn't have any value. That's at some point in the future. So we have to calculate our economic death benefit value, which is generally just like, and literally like dollars, like maybe like $5, $12, I think is the most I've ever seen for them. But it's a very nominal amount that the employee is going to have to pay taxes on. Very, very, very small. We have an independent, or we have a third party provider here in house that we can offer for you. I believe we cover the cost of that calculation. So that's a service available to you as an Ameritas affiliate. Then we have our executives. So the bonus for the executive is they get a lump sum bonus at the end of the service period, whether that's in the form of cash or the actual insurance policy itself. It'll mitigate concerns over long-term post-retirement company performance. So this is that golden handcuff that says I can put it in a performance metric that you work here for 10 years and receive at least a 10-cent stock increase in that time period. Like that's a performance metric that I can use to incentivize employees, to incentivize an employee's behavior over time. So we can actually build that in here. And we can do that with non-qualified too. There's a life insurance benefit here. So the employee is getting more than just cash. They're getting a life insurance policy. That life insurance policy can be a boon because you don't realize you have access to the cash value during your lifetime. You can use it for retirement or any expenses that come up. You can get a long-term care rider on the death benefit to take care of yourself in the event you ever need long-term care. And you have that tax-free death benefit. There's a lot more value here than just cash. And like I said, living benefits, that long-term care and that ability to use your retirement. So the last one on our list today is SPORT. So SPORT stands for Supplemental Platinum Recovery Tactic, but essentially in the wild it's known as loan-based split dollar. So this is still split dollar, except what we're doing here is we're dealing with a loan instead of us just paying somebody. So how does this work? Well, the employer and the employee enter into an agreement that says, okay, employer, I'm going to extend you loans, employee, every year in the amount of the premium. And you agree that at the end of the term period, whether however long that is, at the end of the loan period, you're going to pay all that back to me. And so how does that work? The employer goes and loans the amounts to the employee, which the employee goes and procures a life insurance policy. It pays the premiums into the life insurance policy. Because this is a loan, there is no tax on income. This is not income. This is not compensation. There is no tax. So the employee is not taxed on any of these premium payments, and the employer gets no deduction on any of these premium payments because they are not compensation. They are a loan. They must be repaid. So the employee goes and procures this life insurance policy. The employer or the employee goes and puts all the premiums in there. It builds up some cash value. We end up at the end of the service period, and let's say the loan is due. Well, a couple things can happen at this point. The employee can go ahead and take money from the cash value of the policy and use that to repay the funds. And we would structure it, we would map it out in a way that all of that would work out at the term period. Like we have illustration software that we can show you, especially when it comes to taxes and everything like that, because you can double bonus this and you can double bonus DER as well. We're able to actually illustrate all that for you. But they will take out either the funds from the policy to repay the loan, or the employer could forgive the loan. Now, it's really important that the employer not ever put that in writing, that they're like at the outset that they're going to forgive the loan. It's okay if they do forgive the loan. It cannot be the plan from the beginning. That's a tax. No, that'll get you in big trouble with the IRS. But let's say they do want to forgive it at some point in the future. Let's say we come to the end of our term period, we're forgiving that loan. What happens then? Well, the employer at that point in time would get a deduction because that forgiveness of that loan would be compensation to the employee. So we're deferring the employee's compensation. We're giving them money today to go procure that life insurance policy. And we're saying you have to pay us back in the future. You either pay us back from the difference in the cash value of the policy, and then you get to keep the policy and the difference for free, pretty much. You get a free life insurance policy after you pay it back, or I get to forgive the loan. Now, either way, the employer must charge a reasonable interest rate. It cannot be a below market interest rate. It has to be one at arm's length. So interest will be due on this. That will be an additional cost. But at the end of this, oh, and I forgot to mention, during the term of the loan, where the split dollar comes in is that we are taking collateral in the policy. We don't want our executive to just take the policy and the loan and run because nothing's stopping them from doing that. They can just leave. And we want to be able to get paid back. So we'll take collateral out of that loan policy. And that way we'll make sure that if they were to leave, we'll get the insurance policy back, or at least a portion of the death benefit or cash value to be able to reimburse ourselves. And that collateral will also work if the employee passes away. So let's see that in a step-by-step. We take out a loan with interest from the employer to the employee. The employee takes that premium payment and they go ahead and procure an insurance policy. Oh, 1 second, I have a question. Can the executive borrow against the death benefit? So no, the executive, well, the executive could, I don't know if they could borrow against the death benefit. That I'm actually not sure. I'll look into that one and get back to you, Alonzo. I would assume that they could not. I'm going to go with no for DER. Okay. Sport. Employer. Employer takes out a loan with interest. The executive the employer gives them a loan with interest. The executive takes the loan and puts it down on a premium payment for the insurance policy. Then in the insurance policy, we go ahead and split the death benefit. We split a collateral assignment for the employer and an amount that can pay off that loan. That way, if we pass away or if we leave, the employer will still make sure that their loan is repaid. And then the other portion of the death benefit, whatever is left over during the loan period, will go to the loved ones of the executive or whoever they designate to receive that death benefit. Then as cash value in the insurance policy, we'll have that money for retirement. At the end, we'll split the cash value to pay off the loan, and then any amount left over can go to retirement for the employee. So pretty much that's just you paying off the loan. I'll take money out of the cash value and I'll go use that to pay off the loan for the employer. So what does this mean for our employer and our employee? Well, the employer's side, we have a cost recovery. If the executive leaves the company, dies, or retires, we're able to get all that money back. It's simple to implement with very few documents and reporting requirements. Because this is a loan, the only thing you really need to do is service the loan. That's it. So there's like, you have to have a contract, of course, for the loan and everything, but like outside of that, you don't really need a lot of reporting requirements out. Like there's not much to do. The executive gets a life insurance protection with no upfront out-of-pocket costs. They are getting a loan, they get that protection right away. That's wonderful. They get income tax-free death benefit. That's just standard with owning the policy. They get access to the policy's cash value for their personal needs. So again, the employee is the one that's owning the policy. The employee is the one that has control. Now, I know this was a lot of information. I think it's going to be best if you see it kind of all together. And for that, I actually have a lovely little handout that I'll send to all of you. But in the meantime, it is on the screen. This is just, this is known as our Executive Compensation Strategy Guide. It's a lovely guide, and I will send a copy to all of you at the end of this presentation. That kind of goes and compares all your options here. Option number one, executive bonus. This is that section 162 bonus plan. DER, that's our endorsement split dollar. Sport is our loan-based split dollar. And then we have our non-qualified deferred compensation. So if we go up with the policy structures, I think this is really beneficial when it comes to, okay, who is the premium payer, who's the owner, and who's the beneficiary? Well, if we're dealing with an executive bonus agreement, we know that the employer is paying the premiums, but the employee owns the policy because they're getting paid that cash and then they're putting it into a policy that they own. And because they own it, they get to pick the beneficiary. Whereas DER, the employer is paying the premiums, but the employer owns the agreement. They own the life insurance policy, but they have to split the death benefit with the employee, which is what it says here. The employer owns it, but they split the death benefit. And then the employee gets to pick a partial beneficiary, and the employer is a partial beneficiary to get reimbursed. With sport, the employee is the one that's paying because the employer is giving them a loan to pay it, and the employee is then taking that loan to pay it. So they're the premium payer. They're also the owner. And the beneficiary, it goes to them. However, we're taking out that collateral assignment. And finally, non-qualified deferred compensation. The employer controls it all. They are the premium payer, the owner, and the beneficiary. Let's see if I can get this to go to the next slide. Maybe. There we go. Okay, design criteria. So this is everything from your availability to offer the benefit to employees, flexibility to change the plan, golden handcuffs, avoiding or exposing assets to creditors, plan administration requirements. Like we talked about, there's loan administration just for sport. This requires, DER requires the reportable economic death benefit each year for the employee, and then a TPA is required for that non-qualified deferred compensation. So this is a really great little chart. It goes on and it just has just about absolutely everything you may need. It would talk about taxation and deductions. Do you get a deduction immediately or is it at some time in the future? How is it going to be taxed to the employee or the employee's beneficiary or the estate tax? This is a really wonderful guide. I strongly, strongly recommend checking it out. And like I said, I'd be happy to send this to you after the presentation. Just so you guys all know, this is the end of our presentation, but we have some Module 6 is coming up for the Boom series. Module 6 is covering charitable giving for business owners. So if you're interested in checking that out, feel free to scan the QR code to sign up. We also have a podcast known as the Future Focus, a financial strategies podcast. If you're interested, we did go over some executive compensation stuff on there as well. But if you have any questions, don't ever hesitate to ask. I do see I have one more thing in the chat here, but feel free to unmute and have a discussion. Looks like we have 30 minutes left, I think. 15?
Well, 15 minutes.
15.
15 minutes. And can you go over that charitable giving? Because that's more for nonprofits, slides you have up, churches,
No,
or how does that work? Like brief overview.
yeah. So this isn't about the nonprofit side. This is about the business owners. So these are business owners taking advantage of charitable deductions to offset their income. So a really added value for business owners is like when they sell their business, there's often a ton of gain that's sitting out there. How can you offset the gain? Well, you either pay Uncle Sam or you pay a charity. But a charity might be cheaper for you depending on how we calculate it out, what assets you give, etc. So it just kind of goes over the specifics of charitable giving 101, charitable trusts, where you can do some really fun stuff, like where you can pretty much you can have your cake and eat it too, where you give it away, you get a deduction today, but you pretty much get to keep your asset for your entire life and not actually give it away until you die. Like there's some really cool things that you can do with charitable giving, especially in the business owner context. It depends on, so the question was, would a CRT be more optimal over an ESOP? It really depends on what your goals are as an employer and what you're trying to do here. So I think an ESOP is more employee compensation, whereas CRT is more charitable giving. But I guess it depends on what you're trying to do.
Yeah, I know you gave a lot of options, and thank you for this presentation. Is very valuable. But on that slide though, when you're talking with a business owner, like how do you what's the best way to determine which angle to go? Because I know myself as an agent, I want to go with the easiest, the less complex option, because that seemed to be easier, but that might not necessarily be the best thing to do. So, how do you determine which one? Because certainly you don't want to explain all of this to the client. So
Yeah.
how do you determine, which one and who's best suited for? How do you put that together? Like when we meet a business owner, like which way do we go?
So I think this is our executive compensation guide that I talked about. This is a really great way to start that conversation. So there is this flow chart in here that kind of lets you guide you through what you're talking about. So if we're talking about remember we talked about the questions at the beginning. Are we dealing with a non-owner key employee or are we dealing with a business owner? Depending on who you're dealing with, we're going to figure out what side we're on. If you're dealing with a business owner, we're going to ask, okay, what's the objective? And kind of go down through here and it'll tell you which one you need. But in a more practical way, I think when you're talking to an employer, this chart's going to be better for you because really when it comes to what they're telling you, you can really pick up on what they're talking or like what they may need or what may point to like the best option for them. So for example, we gave some case studies in Boom that I would strongly recommend checking out. That will give you, okay, we have all these different employees that have different roles in the company and different relations to the owners. What compensation structure is going to be best for them? We had, for example, sport. Sport's better for family members because do you want to give a loan to an employee? Not usually, especially when you're dealing with a small business and large sums of money, that may be more apt for a family member or a close person to them. Whereas dual executive reward and executive bonus, I think, are the big number, like one and two that I would default to. If you're looking for control over the agreement, DER is usually the best because you get to offer the golden handcuff to the employee. You get to say, hey, you get to work for me for X amount of time. And if you work for me for X amount of time and achieve X goals, I'll give you Y dollars. So we have the golden handcuff there. We also get the immediate death benefit. That's for the employee. They get a benefit that if they pass away, their beneficiaries get some money. That's awesome. And then when they complete the service period, they can have either the cash or the life insurance policy. So I personally tend to find myself really over in the DER category more often than not. It's a great life insurance sale. It's a great sale that's been great for the employee and for the employer. Whereas Section 162 bonuses, like I said, they don't do much. Like they give the employee a bonus, sure, but there's no golden handcuff there. There's nothing to prevent them from leaving. You gave me the cash, I can take it and run. Whereas DER is like, I'll give you the cash, but at some point in the future. So it really depends on who you're talking to, what their goals are. If they like simple, then we're going to stay over on the left side of this graph here. If they're okay with a little bit more complexity, we're going to probably be in the middle or towards the right here. But for me, I usually find the sweet spots around DER.
And, and with that, how do you determine, how do they determine what premium? Like when we're doing the executive bonus, is it a percentage of the annual income that they defer and put into these plans, or how do we come up with the premium for these
So
plans to work?
that'll depend on whatever the employer is willing to pay. Now we have a bunch of illustration software. Nolt Nicholson and Kyle Runyon and Jacob Messick are, and Brayton Christensen. Those are all members of my team, are wonderful people to reach out to for illustrations in this area. They'll run it for you and show you, okay, if you paid this much premium, here's how much this would be, and here's how much this would be. And they can figure out the numbers for you. Like if your goal is to get X dollars in death benefit or X dollars in cash value, they'll calc it out for you and figure out how much premium you need to get that. So if we're trying to like backdoor our way into an agreement where it's like, I'll pay you 100K in the future, but we can't figure out how the cash value is to get to that 100K to make sure there's enough money there, we'll calc that for you, if that makes sense.
Yes, and there's a question in the chat from Sean, and she's wants to know: is there an assessment they can take to determine which type is best for them?
We don't have any specific assessments that we can give that are best for them, but like I usually find using the Source in Six or our business planning fact finder, which is available for you on Producer Workbench. I'll send a copy of that with this as well, is a great way to navigate those conversations to identify which one is the best for them. Because really, there's no one size fits all with these conversations. It's just listening to your client and saying, okay, what are their goals here? Do they want to keep the employee for long term? If they do, we're not looking at section 162. We're looking at these three. Do we care about the deduction today or in the future? When do we want that deduction? Like those types of questions that we asked at the beginning of the presentation, I think that would get you there. And honestly, just following down this chart, this will answer all of your questions. If you just take this to whatever they're saying, this will get you exactly where you need to be. And if you're ever concerned and you're like confused, you don't know, come to us. We're happy to listen to whatever the case is and give you advice on what may best fit their situation. We do not expect you to be experts in this. We're the experts in it. We're here to help you. We do not expect you to be an expert. So come to us if you ever are concerned. We're happy to help.
I like that option. Do the business planning fact find and then come to you.
Hmm.
And
And
is it?
then
Mhm.
we'll go on. Go ahead.
No, there's questions in the and I don't know if you see it from Alonzo.
Yep. Yep. So would this 162 be better for single member LLCs or sole proprietorships? So a section 162 would be fine for just about anything. The only type of executive compensation that I'd be wary about with entity structures would be any kind of deferral under non-qualified for S corporations or pass-through entities, and it's only if they're owners. So if it's an employee and it's a pass through like an S corp or a partnership, that's fine. But if it's an owner employee, like who's both an owner and an employee, then we have a problem because we're not deferring anything anymore. We want the deferral, but we're not getting that if it's a pass through. And that's probably a topic for another conversation. We can talk about that further, but I'd only be worried about your or your S corporations, your pass-throughs, and that's only with non-qualified deferred comp. And then there's a second part. It's probably best to get them a business valuation first. Can you tell us who Ameritas partners with for those? I forgot the firm. Love that you brought this up. The firm's name is Marshall and Stevens. And for the valuation, we don't need a business valuation for the 162 bonuses or any of the executive compensation. You would need it for a buy-sell arrangement. Like if you're trying to figure out how much life insurance you would need to finance the buy-sell, that's who you would use Marshall and Stevens for. In fact, we offer a service for you with Marshall and Stevens. If for the right customer, we'll actually cover the balance for you. We'll actually cover the cost of the service. And this service can usually range for about $3,000 to $5,000. So it really helps your client out quite a bit. Now, what does the right client look like in order to get this free service? That is a business owner who has more than $5 million in gross receipts being just your sales before you reduce it for any costs or taxes or interest or anything like that. So just your net or your gross sales, the amount of cash you get in. As long as that's $5 million or more, we'll go ahead and cover the cost. But let's say it's under 5 million. If it's under 5 million, we went ahead and negotiated a discount with Marshall and Stevens. That's going to be $1,750, which is less than half price for what a regular valuation would go for. And in order to start that process, you would just email myself or Jeff Smalley, and we'll send you over a questionnaire and the information we would need to get that ball rolling. I suggest the valuation to open the door to speak to the client. This way, they'll be more open to speaking about executive bonuses. I guess maybe, yeah. I guess I would talk to them about their buy-sell agreements too, just kind of like what their retirement plan is, especially when it comes to executive compensation. When you're talking about the retirement plan and the buyout, that would be a great way to kind of cover both birds. Because a lot of small business owners, a lot of their wealth is tied up in their business. They don't really think about retirement outside their business. Their business is their retirement, but they don't really think about how they're going to get their money out of that business. And so that's when we start talking about buy sells and life insurance and getting that valuation done. But we could also talk about executive compensation. Like, okay, have you thought about getting your money out this way? You can get it out with sport and then forgive some of this, or you can get it out with DER. This is just another way to get money out of your company. That could be a way. But I don't know how evaluation would help too much with the executive bonus part. But I get where you're coming from. I think it's a good thought.
Anybody have any questions, you can put them in the chat, or I don't see any more questions. Yeah, I don't see any more questions. Do you, Keali?
Well, I'll
Um,
go ahead and send over that fact finder and this as well. And if anybody thinks of any other questions that they didn't have an opportunity or just didn't want to throw in the chat here, feel free to just shoot me an email. I'll go ahead and throw my contact information back on the slide here. I'm
And are you
happy to help.
available to hop on a call? Let's say we do have a client, a business owner, and you're willing to do like a three-way call with them or hop on a Zoom with the
So
client.
we have to be very careful with when we talk to clients just because as an attorney I cannot give off the impression that I'm giving them legal advice. So depending on the topic, I can come in with executive compensation. If it's something you're uncomfortable navigating, that shouldn't be a problem. But we usually like to save getting us involved with your client conversations for like something that's really complex but not legal advice. Does that
And
make sense?
you do have client approved videos for I thought I saw somewhere where we did have client approved videos. I don't know how to get to them, but that's something that we can um help steer this conversation, correct? With the
Yeah.
videos.
Yep. I think they're on producer workbench. I think. I'll have to look into it, but I'll make a note of that.
Great. So I don't see any other questions, and thank you so much. This is very helpful. And a lot of business owners, they're not aware that these programs even exist, or even how to package them. I know there's several, just in where I'm at in the New Rochelle, there's several business owners that, we can get a list, and just like if you had that email, and maybe we can send out the videos to kind of warm them up and follow up. But these would be some nice premiums as well. It's
Hmm.
definitely nice cases. And last question from UC, what product work best with these plans? Would you say whole life, or would you say the IUL work best to structure these policies? Was there a
So
preference?
we have a saying in advanced planning, we are product agnostic. You can pick whatever you want to use with it, and we will make it work. So there's no preference.
Okay, great.
Eh,
All right. With that said, Kelly, thank you so much, and everyone enjoy the rest of your day. I'm here in the office if anyone has any questions, and we really appreciate it. Thank you so much.
Yeah, thanks for having me.
Awesome. Have a good one. Bye bye.
You too. Bye.